Great. Thanks, Bethany. Welcome, everybody. My name is Chris Gallo. I lead the state and local tax practice for Bergen KDB. Today, we're going to be talking to all of you a little bit about the new complexities and the things that we're seeing post-Wayfair 2018, 19, 20, and what's up with 2021 and the new things to be considering in 2022. My colleague here is Larry Mellon from Vertex. Larry, you would introduce yourself.
Thanks, Chris. My name is Larry Mellon. I'm a tax director in our chief tax office. I've been at Vertex for just about 17 years and have been in a tax industry related field for over 30 years, both in retail, heavy manufacturing, et cetera. So I'm looking forward to co-presenting with Chris today. Thank you.
Awesome. We'll go through the agenda. Excuse me. So we're going to go over latest updates on SALT, affectionately known as in state and local tax, the outlook for 2022, the effects of COVID-19. If we create any questions for you guys, make sure that you reach out directly to the facilitator. You can ask those questions. She'll get them into us. We're happy to answer anything as we're ongoing and they come in. Are you in compliance pursuant to the new rules that we're seeing? And then again, we'll follow up any type of Q&A as they come in or at the end of the session here. Important to kind of keep in mind as well, this is a part one of a two-part series. So we'll go into how to evaluate your compliance, what may be next steps, and then the two-part series will be what to do about that, how to handle if you've discovered any issues. So with that, Larry, let's jump right in and you can lead us into the latest updates on SALT.
Great, thanks, Chris. Thank you, everybody, for joining too. So just wanted to touch base on a few things that we see that are coming down the line, just to give you some information. Of course, we know as we present, some of this stuff could be older, some of the stuff could have come out yesterday, but we'd like to at least give you a little update on where we stand on a few things and then see if that prompts any questions or just some information for you to be aware of. So digital service tax, which I'm sure many of you are aware of, especially as the state of Maryland worked through to adapt that, and more states, of course, are looking at that, especially because of the wide variety of taxation and how it affects across the entire U.S. and outside of the U.S. for that matter. So, but what we're seeing more is jurisdictions are looking at the positions that they have. They're determining that they all came on board. They basically adopted standard rulings that were out there, and now they're starting to dig a little bit more, and they're starting to tweak. So some of these jurisdictions are looking at changing the standard amount of either threshold of amount of transactions or dollar amount of transactions. They're starting to look at it to see what's affecting for them. Based on a lot of the stuff, they're looking at this stuff because they're seeing that potentially people aren't as well as compliant with it too. They're, as they're doing audits, which most people are just touching on it because it hasn't been around, say, the 3 or 4 years, depending on whatever statute limitations for each state. But they are having that discussion with people when auditors are sitting, whether it be in their office or remotely. They're still having the conversations to say, are you aware of this? Now, they're not being upfront and saying, hey, we're going to be coming after you, take a look at this stuff. They're not going to do that. One, because they don't want to show their hand because they want to be able to come back and get it. We all know that being in the tax industry, but they're also just want to make sure that, they're looking at how this stuff has worked, how they're taxing it, where is it being used or where it's consumed. And a lot of people, of course, have that whole mindset of, where's the service performed, or where did I sign the contract and that's where it's done, or where is my ship to address in the system of how I'm being invoiced. So they're looking at that. So you need to really keep an understanding if you're someone that has digital service taxes, especially if you're someone who's invoicing someone, you want to be clear on how you're going to map your taxation of that stuff. And of course, a lot of, I would think predominantly all of us at some point probably have invoices that we are processing on the purchase side for digital services that we have. So as that stuff's coming in, we got to make sure that we're looking at that and where is it consumed and used, and what is your state, local district, what are their rules based on that. as well as the European Commission. They're certainly involved in this too, and we're seeing this stuff worldwide that, everybody's looking at digital service tax, and it's not predominantly just a US thing. But many of these countries, they're not getting um, potentially the EU has not dictated one specific area and how they're going to tax that. So we're finding that there are a number of countries that are doing an interim, like they're saying we're going to put something in place. And I don't want to use a term like see what sticks and what's out there, but I think that they're trying to see what they can do. They're working with industry out there, and they are coming up with some things. But they're a little bit behind us on some of those things, and they're a little bit more aggressive in other countries and stuff like that. But as far as the EU as a whole, they're really not have pushed it as far as we have at this point.
Hey, Larry, fair
Yes,
to say,
sir.
touching on the EU, they're
Yeah.
employing that tax at like $1 right now with
Yeah.
the digital tax, right? And
Yep.
also fair to say that the day of received online or digitally transmitted is not taxable. It's pretty well over.
Right.
It was the new hotbed for the states to, create new taxable products through those digital services, and just about everyone's got them. So if you think you're
Yep.
buying online, receiving digitally, it's not taxable.
Right.
Uh,
Agreed.
those days
Yep.
are over.
Yep. Good point. So I want to talk a little bit just on Nexus and marketplace. So what we're looking at, we're seeing some of these manufacturers, we're seeing less tax compliance reporting jurisdictions, where they have this physical presence, and increase where they're shipping. So in a sense, we could be seeing exactly what's supposed to be happening. We are seeing that they're looking at this and saying, well, I was always doing the tax where I've at, where I'm located, where the stuff is where is it being shipped. But we are seeing that they are taking a more stance of being able to be able to show taxation on where it's physically being performed versus where an actual ship to address. So we're seeing more and more that we're seeing that these states are looking at this, and that these manufacturers are kind of getting up on this. And I'll revert to the last thing, saying that, audits, we're still working through this. Marketplaces are still coming through. Auditors are still learning. We're just getting back. We're getting stronger with audits. So they're still working through a lot of these things. We're seeing that jurisdictions are coming back, and they're kind of challenging, you as the customer, or the business is basically looking at it, and you're determining its taxability. And a lot of times there is that conversation with taxing jurisdictions on how you perceive how that's working through the marketplace and how you're showing that tax. And a lot of that has to do with how the type of software and stuff that you're using to be able to provide that. So they are working through some of those things. Also, we talked about this mobile ordering, which is a huge thing. Everything's through mobile ordering and stuff, but a lot of these jurisdictions are classifying it as a data processing. You're basically putting something in, you're processing this, it's an order, it's online, you're doing it by a handheld. So businesses need to really be careful about their taxability mapping. Just because you have to make sure that you're doing it based on this, what is this nexus? What are my rules on here? Is this data processing? Does it still fall in line with how we do the product if we delivered it not electronically and stuff? So there's a lot of issue going back and forth on there. And it's just like, we know that it's still continuing change. We know that marketplace is still changing. A lot of these states have signed on and are doing stuff with this, but they're still ever changing with the marketplaces as we look at it now. As far as this litigation, I just wanted to just bring up this one because, Massachusetts Supreme Court, we talked about software purchase. We have so many people at businesses that buy software, right? We buy software, you get it, it comes in. How did you get it? Was it SaaS? Was it delivered by a CD? Was it electronically? What was the means that you got that? Do you physically have it on your network? Is it on someone else's? So what we're finding is that, we certainly have those struggles between customers and industry on what is that appropriate sales tax to show on that invoice based on where that's being performed. And a lot of system limitations on company, well, you can only give me one address, and that's how I have to tax it. Because they don't have the bandwidth to say, I sold you something for X amount of dollars and I have to tax it 10 different ways. A lot of businesses don't have that ability to do that. So what Massachusetts basically looking at is saying that, these companies are going back and they're apportioning the sales and use if it's used in multiple states. The burden then becomes on that company to be able to say, I have X invoice, one invoice that has all this transaction, but I'm using it in 10 states. And we have to be very detailed to make sure that these businesses are working to ensure that they have this documentation properly calculated and apportioned across, so that, especially when they come under audit, they're going to look at it and say, well, wait a minute, you've adjusted the amount of tax that you sent based because you're using it in different locations. If you're offsetting tax on one, are you adding it to the other? So as we start seeing more and more of these states coming through with this apportion, I just encourage everyone to make sure that they look through this and make sure they're apportioning that correctly and doing the calculation. Can we go to the next slide? Great. So some of our outlook for 2022, just a few things on here. We just want to say the digital service tax not going away, still going strong. It's going to be reviewed multiple times, especially because we haven't had a full 3 to 4 years to be able to look at this for audit. So we're going to see stuff come down after that. A lot of new things that are coming up, social media specific. There's ad tax proposals that are going through. We're recognizing 4 states have been working on the sales tax on the advertising revenue of social media. We know that, like just we said, the advertising is so big and people are doing stuff with everyone being remote and, not just everything through social and apps like that, that they're really digging in and looking at that and saying that this advertising, that they're missing potential tax on this stuff. How is this being done? And how are they handling it? How is it being reported to them? And I still don't think that those 4 states really haven't even clearly defined how they're going to track that. How do we know that mobile ordering, how does that get reported? And what are these multiple amount of companies that have social media? How are they presenting that? How are they getting it back to them? I think that, we talked about marketplace provider, right? The word provider. State jurisdictions are revising that definition, right? Be sure that you review the definition, because you're talking to your customers, you're taxing these customers, you're determining what you're selling, determining what's considered a provider. We're starting to see a few states that are revisiting the definition of that. And we know for everything that we do, when we as the tax side are making decisions on how we're going to tax our products and services, we have to have a clear understanding of what we are providing to our customers. So in this case, we really have to make sure that we understand what a provider is and what that taxing jurisdiction determines a provider is, to make sure that we are then taxing our customers correctly. So I just want to say, keep an eye on these areas. They continue to change. Like I said, many taxing jurisdictions, I mentioned before, these auditors are not familiar with these changes. They're learning as they go along. We've done specific other sessions where we've asked some people, has everything changed for audits? Is it getting back to normal? Some people are saying, yes, I'm getting back on the same cycle. We found a way to work through this. We're getting information, and auditors are there. Other taxing jurisdictions are saying they're still having difficulty bringing staff back to be able to do this. Some states are making it a priority, saying we need to bring the audit staff back first because they're going to want to help us create some revenue. So just keep an eye out for that stuff, and then make sure that you're basically handling those assessments correct, in all of those areas. Some effects of COVID-19, we're still dealing with that. We see different states have mandates, and the taxing jurisdictions are still dealing with that. There's so many times that people are trying to call in, or they're trying to get answers. I've submitted a return, I've issued, and they're getting pushback. So we're certainly still dealing with that. We go through phases, and of course, since we're very much dictated by one taxing jurisdiction or one state, or even a municipality down to that level, handles things different for COVID, basically determines whether people are back. A state may say we're open, a city may say we're not. So if the taxing jurisdiction's in a locality versus a state area, they may not be operational. So all that is still playing into the fact, and understaffing has always been the leading cause that they continue to use when industry and businesses try to reach out. So although businesses, we're certainly adapting to compliance requirements, still too many staffing issues. Businesses are seeing an increased turnover, right? So we're seeing that more and more businesses that had people that were sitting in an office Now we're allowing people to work more remotely and they're not there, that we're seeing more and more people that are shifting their focus and where they're working. We're seeing that some of them, well, this company will give me the opportunity to be remote. This company wants me to be in-house. That may be a reason for a switch and vice versa. So we're certainly seeing that, and I'm sure, Chris, you've seen that too, where a lot of people are starting to change and some companies are, want to bring everybody back. Other people are saying we're still going to stay closed and nobody's coming back. So
Yeah,
all that industry is changing.
you bet. And one thing that you had touched on around staffing in the state agencies, they, because they're having these problems, wait times are longer on hold, which you wouldn't imagine even to be possible, but it can be hours. Response times to inquiries of mistakes made by either your business or the state, mistakes are going up too. So the states are making a lot of mistakes. You might get a notice from the state that's automatically generated saying that you didn't file a return or make a payment, and that's not true at all. Then you got to follow that up with somebody who may not even be actually there with access to the system, which is creating a real hiccup in just compliance measures on ongoing production. So all of these things are still very much in effect. Quickly touching on 2022 and what's new, audits are going up. We're starting to see an uptick in audits throughout the country already.
Yeah,
Questionnaires and audits, so you should definitely expect those.
right. And with COVID, we've talked about how potentially where you're located, that with those remote people that you have working, that you may be working in a different city or a different state, depending where you're located. So there's been a lot of potential wage differences with that. I think there was just a thing recently with the city of Philadelphia had so many people that were working in the surrounding counties that they're working with their employers on completing documentation to go back and get wage tax from working in the city back because they physically weren't going into the city. They were required to be home. So some of these larger cities are starting to do that to try to get the money back for their employees that are out there. So you might want to keep an eye out on some of that stuff as well. And same thing on my last slide, just as Chris was saying, audits are increasing, virtual audits. There's a lot of people who've always worked on, I want the audit inside, want the auditor here. Basically now that we're working remote and we are doing things more compliant with our filings every month and stuff like that, that we found ways to meet that way. So now auditors are jumping on and saying, well, you're able to provide your return every month, let's sit down and do an audit return. So that's been helpful for some employers and not for others, and it's just how you want to work it, but they are increasing. So just a few things we talked about, like, are you in compliance? So just some key areas that we were talking about. We all know that compliance is tricky, especially if you're doing the same process periods of time. We just put a couple things together just to kind of look at some of the things that we had said. We were just kind of talking back and forth. You're filing so many jurisdictions. When was the last time you looked to see, has there been any changes in that jurisdiction? Not so much about the products and services that you provide and what its taxability, but has something changed for that jurisdiction? Has anything changed? We also see an uptick in local taxing jurisdictions. I think that we noticed last year, I think it was somewhere, there were 137 new local taxing jurisdictions across the board that were put in place last year. So you look at that and say, well, now am I subject to that local tax for what I'm selling, or am I subject to a local tax for what I'm purchasing? So I think it's a matter of, we kind of spend a lot of time and emphasis to make sure we're charging the right amount of sales tax on our side, but are we also going back to make sure that, that we're addressing any new taxing jurisdictions that come in there? On the same side, we're looking at this, and saying, have we looked at it? How in depth do we look at our use tax side of it? Right? Most people, when an auditor comes in, they're good. I know what I sell, how it is, it's taxed. They boast. I went through an audit. I didn't have findings. I had minimal findings on my sales side, but many people don't spend a lot of time looking at that use side and that purchases. Reverse audits are something that are key that should be done, something done in-house to look at how do we handle those transactions. I'm sure that more and more people, as you go through state, local jurisdictional audits, as you see the amount of time, auditors these days seem to be spending more and more time on the use tax side than the sales side, especially because if you're a company that sells very few products that are taxed the same way, they see it once, they're kind of gone. On the use tax side, you're buying everything from toilet paper to whatever. They're looking at those things, so they're spending more time. So those local taxing districts, we're definitely seeing a larger increase, not significantly amount in rate changes. We are seeing some uptick on rates, but most of it is the fact that they're adding new areas, and you guys really want to make sure that you address those areas. All right, Chris, it's all you.
Yeah, thanks, Larry. Good stuff. For those of you who don't know, Vertex, the sign behind Larry, that's the engine that powers Amazon. I think probably most of the top 100 companies in the country and around the world. Larry's one of the guys making sure that they're doing it right. So the information is legit. So thanks, appreciate that. Based on all of that good stuff, and it was just an absolute minimal sample as to really what's going on out there. What do you do with that information, right? How do you interpret all of this? How do you interpret it and apply it to your business? If you're trying to do it on your own, good luck, I guess. If you have somebody doing it for you, I would really encourage you to be very, very careful on who's providing, the advice that you're getting, right? So how do we do it at Bergen KDB? We've got a team of people that work on two sides of the tax aisle, if you will. There's the advisory side that does all of the research, interpretation, legal interpretation, really provides what we're going to be looking at here: compliance reviews, nexus reviews, taxability studies, other tax studies, compliance studies, all of that good stuff. And then it's handed over to the other side of the house, which is ongoing compliance. That's the next seminar, but really that's the type of thing that you want to be thinking about. So we're going to understand on how to look at these things, what it all means, and then what to do about it. So first things first, I'm looking at my spreadsheet over here, which is, I think, well, let's see here. It's however many columns BA is from A. So it's a massive matrix, and we're just giving you small samples of what that looks like, what the process that we use to go through to determine taxability and nexus. So if you look here, starting on column A, what state? Okay, so pursuant to your business, what do you need to think about? These are the thresholds around economic nexus variables. First thing to look at. So how much business are you doing? How much are you selling into a given state? What is the threshold of that state, right? How are the transactions considered in the Department of Revenue? So are all transactions included? Is it just retail? Is it gross transactions, or is it taxable transactions? So you can see here, just in A through C, you've got retail, gross, taxable, gross, retail, and all of those could be different. So just Alabama alone, $250,000 of retail transactions in a calendar year, okay? The effective date became, well, effective 10/1/2018. So where you start on column A, line 1, Alabama, you got to start to think back to September 30, 2018, the whole way through 17. So it's the prior year. That's where the exposure starts from an economic perspective. And it's calculated differently in each state. Some are the same, but many are different. And here's just a quick snapshot to show you some of the complexity. One thing to point out here really is Arizona. If you look at Arizona, the threshold was $200,000 in 19, 150 in 20, 100K in 2021, and now it's going to stay at $100,000 gross sales made into the state of Arizona. Key point, gross being taxable and non-taxable. It's a common misconception that, I only have taxable sales that are under the threshold. Doesn't matter in many states. which can in turn then require you to have to file even a zero return. So complexity is created in the first 5 lines that we've got here. Larry, did you have something you want to add?
Yeah, I think that I think that's fine. I think that many people do lose track of that gross versus taxable amount. And I think that what a lot of people see when they're looking at that risk assessment, they're primarily looking at what threshold they fall in some of these areas, and they only look at that taxable. And I think that especially when it comes for audit purposes, a lot, they're spending a lot of time on how you've deemed something as non-taxable. It's not so much exempt, but it's something, why have you deemed it as non-taxable? They spend a lot of time evaluating and looking at that.
Yeah, good point right there. There's a difference between exempt and non-taxable. Exempt to the client with an exemption certificate is important. Exempt or non-taxable by law at the state level, it would apply to everybody. A very, very key distinction to be made. So we can move on to the next slide here. So like I had said, we would start with a nexus study of when did you actually cross the line. So we're kind of moving through the matrix here, and we do an evaluation of 2018, really prior, 17, 18, 19, 20, and now 21. We took this, we have, I don't even know how many different matrix that we use, but this one is for a manufacturer. That's intentional because most manufacturers figure, yeah, we sell to wholesalers, no big deal, non-taxable, we don't have any compliance issues. But here's a few things that you need to consider. One, the number of transactions is also includable or separate, I guess, to the gross numerical threshold. So gross sales is the how much. The number of transactions is starting to be eliminated, but in states, there are still some states that include, if you have 200 transactions, it doesn't matter what your gross sales are. If once you cross the 200 individual transactions, no matter the dollar amount, you could trigger economic nexus. Some things to think about as even just from manufacturers, but just showing kind of some of the complexity. You got to think about parts. So you may sell machinery, but do you sell parts? Do you sell replacement parts? Is the machinery equipment? Is there any new installation or just installation of repair parts? Okay, you can extrapolate this across any industry. All right, so whether it's installation maybe of just security systems, right? Could it be the sale of foods? Is there delivery involved? Are you just selling widgets? Is there digital products that are included, like Larry had talked about, right? Shipping is taxable in some states and not taxable in others. And I kind of had mentioned that before. In a shipping process, do you, the supplier, arrange for shipping, or does the buyer arrange for shipping? That scenario right there could create taxability or eliminate taxability. So through all of these considerations, we then come up with a sales total. We run the numbers just from an economic perspective, and the blue column there is total dollar sales subject to tax. That's the gross number. Moving on, gross sales number. We then go into, so that's the first thing we're looking at is how much did you sell remote? Did you trigger any nexus, economic nexus variables in those states? We then look at physical presence. So you can establish an economic presence without establishing a physical presence. If you have established that physical presence, all economic is out the window. $1 at moment 1 of physical presence establishes nexus in that state and then creates a compliance requirement. If you are in the state physically, right? Are you filing a withholding tax? Are you currently filing a sales tax? Do you file an income tax? And there's many other taxes that could also be included. Gross receipts tax, consumer's use tax, personal property tax, all of these, franchise tax, business tax. There's a lot of other taxes that you may be filing without considering should you be filing the sales tax. And this is what many states are starting to look at too. Are you filing an income or a withholding, maybe a personal withholding, a payroll tax, and are you filing a sales tax? If no, why not? Seems like a good reason to make a call or send you a questionnaire. Larry, did you have something to add? I was going to use that to take a drink.
Yeah. It took me a few seconds to find the mute button. Sorry. No, I didn't, no, everything you said was fine. I don't have anything else to add.
Perfect. So then what this is producing, again, snapshots, but it's producing as we move from left to right in the nexus matrix, the exposure. So have you created physical or economic nexus, and what is the exposure? Moving on. Okay, so if you have a gross dollar amount, right? You made $1 million of sales into a state, and we've determined that that's been happening year over year for the past 3 years. You know, you got $3-4 million of gross potential exposure. Does it matter? Probably, but then what is the reality of, you know, this exposure? Do you have an exemption? Okay, so what's an auditor going to ask you, right, when they find out that you have exposure? Well, if there's exemptions, are the exemptions valid? Are they properly filled out, right? Are they current or have they expired? And I swear every state has a different threshold around an exemption certificate. So backing up, it's what are you selling and is it taxable, right? In the manufacturing industry, you have parts. Are the parts exempt? Are they differentiated between repair parts and new parts? Is there a service that's provided, right? Do you install it? Maintenance contracts, right? Are they mandatory or not? These are all things that determine taxability. So once you, and again, it doesn't matter, I'm just using manufacturing as an example here. If you're in the construction industry, the service industry, the professional service industry, that's another area where professional services are starting to become taxable more and more. We see that. Okay, so don't just assume because you're providing security services, was actually a question that just came up today. Those are taxable.
Yeah, Chris, definitely. Professional services is really increasing. They're starting to look more and more of that, especially because we're more remote and working stuff, and people are determining, businesses are returning, are, you know, basically saying things are more of a professional type environment. So they are starting to look at that. We're used to be able to just say services, nope, off the board. And there were so many few things that were in there. Now they're looking at professional services, help supply services, all that stuff greatly across all the states.
Yep, yep. If you're providing even widgets, right? Maybe you're selling TVs, maybe you're reselling, you know, heavy machinery or just machinery chainsaws. It doesn't matter. Maybe you're renting stuff across state lines, right? You could be, and in fact, that happens a lot. Is there a maintenance contract that comes with the machinery? Do you have a warranty that comes with the TV? Right? It doesn't matter if any of these types of things are being sold in conjunction with what you're selling. They could be taxable, and it could make the product that you're selling taxable as well. So you need to be careful with all of this. And once we take the gross number of sales, we then ask all of the other applicable questions to determine what is the actual taxability. It's not necessarily just how you sell it. You can't just bulk sell something on an invoice and say it's this, right? You have to figure that the auditors will ask you what is included in this line item.
And
Another
Chris,
thing,
also, yeah.
I'm sure a million times, right? Bulk invoices or bulk contracts generally just become taxable because the auditor will assume something in that service or that product line, right? That bulk invoice is taxable, thus making the entire thing taxable.
Yeah. So just one thing I want to add is you're looking at using the title of taxability study. A lot of times you have to look at the capital assets that you're purchasing. You know, sometimes you have everything that you're buying that's coming in. You know, many places that you buy from use an exemption certificate as a common get out of tax-free card. Yeah, they just think, let's throw it and see if it sticks. And under audit, some of that stuff's getting pushed back. And to Chris's point, some states are 1 year, some states are many more years for how long they're good for. So I always said that, especially on the capital side, like you need to work closely with your accounting side when they start coming up and you're using for income tax and apportionment, you're coming up, what are all the new additions that were made? Before you close out those capital assets for a year, maybe somebody on your sales tax side should be looking at them. Maybe you should be evaluating every new asset, depending on the size of your company, but maybe there's thresholds. Maybe you're looking at assets that are put in place to say, yep, before that asset's closed out, we looked at it for sales tax or use tax purposes, we're correct. And then when audit comes, because they're going to say, I want to see this test for sales, but I want to see 100% of your capital assets. And you could at least be able to step back and say, well, for the ones that were over this percentage or this threshold or 100%, whatever it may be, we've evaluated this to ensure proper taxation before we close that asset.
Yeah, great points. Well, let's move forward here. One thing to consider while we're doing that, you had mentioned audits, and in the past, it was not entirely common, or people just didn't care, right? The auditors would bring it up, like, hey, are you handling use tax? Yes, okay. It was never required to be a footnote if there was ever any discoverable liability. It's becoming much more common now, and most firms are starting to require that if they discover an unpaid use or improperly collected sales tax filings, that they note it in the audit. It becomes a liability. Well, here we go, liability calculations. So once we've gone through the gross sales, we've gone through the taxability, we then apply it to what the rates in the states are, okay? So you've got the state sales tax here in Alabama, it's 4%. And then the highest local rate at 9%. You want to kind of get a general understanding of what it is that you're going to be owing in a state based on the compliance or lack thereof in the processes. And when you aim at the highest percentage, that's where we are going to get the estimated state sales tax exposure. So 4% Alabama, a total of potentially 5% throughout any given local jurisdiction, for a total of 9%. We then go through the estimated local sales tax exposure, the actual taxes then due, and the difference between the estimated and the actual. All right, so all of this is put together in a report. It's not easily readable, but it is if you have somebody going over it, so you can really determine, and then we'll show you how it is that we determined and why based on the state taxing regulations. Next slide, please. So the income summary, what are we looking at? A couple of things to be considering now. I firmly believe that income tax in excess is the next thing to change. Sales tax used to be prior to Wayfair, right? Only if you were physically located in that state could the state compel your business to collect sales tax. Obviously, that's all changed. And I do believe that income tax nexus is going to be changing soon as well. It already is. There's a common or becoming more common phrase, which is called market-based sales. And states are now requiring or trying to require income tax being applied and filed and registered in that state based on market-based sales. Market-based sales is total gross sales done in that state. Local municipalities, Larry, you and I were talking about this earlier, are absolutely requiring that you file income tax in the city of wherever, I believe it's Philadelphia in Larry's case, even if your employees or you have no physical presence in that city, but you're doing business in that city with other companies that are in there. Did I get that right, Larry? Cool. So you can see here, yep, corporate income tax. Does the state have a tax? Yes, it's got a corporate income tax. And then there's other tax types. So you might think you've got sales tax down and income tax down and use tax down, but what about the other tax types? In the state of Alabama, there's another tax. It's called Business privilege tax. And I can read it quickly if you can't. It's levied for the privilege of being organized under the laws of Alabama, doing business, and so on and so on. Arizona, a transaction privilege tax, commonly known as TPT. And that's another privilege tax of doing business in the state. And I had already alluded to gross receipts tax, franchise tax, personal property tax, and all of these can be attached to general sales. Next, please. Some implications or some thoughts to take into consideration around the state. The income tax summary, again, physical presence. Does the state have an economic presence standard for income tax, right? We're not necessarily getting into the income tax, but you have got to take these things into consideration because economic nexus from a sales perspective can be applied from an income tax perspective as well. So if you're filing a sales tax and not an income tax, that's yet another way for the state to be reaching out to you. And you can see, I forget which state it is to the left here, but does not have a physical presence requirement, or there is none, but there is an economic income tax requirement too, and it's imposed on every corporation having a business status in the state, having either income resulting from activity or income derived from sources within the state. So they are saying in that state that even remote sales with no physical presence is deriving income from that state, thus requiring an income tax return.
Yeah, I think we're seeing more of that, especially with Wayfair. We're seeing more of that increase going, across the board, where we're going to see more jurisdictions that are going to pick up on that. They're certainly going to be looking at how can we potentially get more income, even though, we're physically not there, or the presence of business is moving. How do we derive income just from activity in our taxing jurisdiction?
Yep, factor-based nexus, another way of saying market-based sales. It's the factor-based nexus, and I guarantee every CPA out there is saying right now that, oh, Chris isn't considering Public Law 86-272. On the contrary, I am considering that, and the states are as well. Okay, and they're saying forget about it. I'm here to tell you, Public Law 86-272 is the next one to fall, just like Quill was from a physical presence perspective. Next slide, please. Perfect. We must have nailed it. So are there any questions, thoughts, concerns? That's pretty quick, and there's a lot there, but that is, I guess I would wrap this up by saying, one example of over 400,000 lines of individual state and local tax code, and over 11,000, 12,000 now taxing jurisdictions across the United States.
Yeah, we do have a couple questions here. If anyone does want to submit any questions here while we're live, feel free to in the chat. The first question here, if I do have new employee, remote employee, and I'm only making payroll tax payments, should I be making other considerations?
Yeah, answer is a definitive yes. So if you have other employees, and they don't have to be physically in another state, salespeople constitute nexus in a state. So a salesperson going into a state, taking orders, making calls, delivering products, that constitutes physical nexus.
And it could be a local jurisdiction too. Is it 1 day? Is it 30 days? Each jurisdiction is going to have different regulations. So yes, you have consideration.
There's also to take into consideration going to trade shows, making sales, doing these things. That trade shows actually can establish a physical presence. And if you're doing that and making sales, there are temporary sales tax filings that are required of you in that state as well. Nevada's great at it because Las Vegas has a whole ton of trade shows.
Yeah, there are a lot of people who look at it and say, what is the threshold to be in this city? Say Vegas as an example. If there's a threshold, companies may be looking and saying, we can't send this person because they've been there X amount of times. And that's, some of the way that they get away from that, just to be able to, not have that obligation, but you need to evaluate it.
Yeah, it's a good question, because the other things to take into consideration, maybe you're just selling TPP, right? You're selling security systems. This came up earlier today, so it's on my mind. If you're selling the hardware remotely, right, and you've got no physical presence, but you also hire contractors to do the installation, and that contractor is paid by you, hired by you, and then managed even remotely by you to install anything. I'm using security as an example here. That the states will consider that third-party contractor as creating physical nexus for you in that state, therefore requiring you to collect and remit sales tax in that state just based on hiring a third-party contractor.
Right.
There's other ways of creating economic nexus too. Massachusetts is one of my favorite, which is called cookies nexus. So just buying something or selling something into the state of Massachusetts. When your consumer clicks on your website and buys something, they create cookies for you in the state of Massachusetts. The state of Massachusetts says that's creating physical presence.
All right, great stuff, guys. Here, the next question. If I feel that my business may be out of compliance, what is the first thing I should do or look for?
Yeah, go ahead, Larry.
Well, I think that one is recognizing if you think you're out, then there must be something that you've identified that caused you the risk, are you not taxing something accurately? The first thing you have to do is you have to determine what that is. What is the effect of that? What is the physical dollar amount? And then, of course, with rules, accounting rules, then you have to document that. You're booking a reserve for that to say, at least letting the organization know that, yep, we have this issue. I would let the powers that be, regardless of where you're at in the rank and file of the business, that you've recognized where this is right away. I would certainly go into it with what is the issue, where are we compliant, what's that cost us, so that reserve can be booked so that if an auditor does knock on the door, you already have the funds set aside before it comes into play. If you've already done that and some of the steps, then you want to certainly work on how are you going to turn on to start taxing accurately as you thought it should be. I don't think it's something where you have to step up and submit funds to a jurisdiction right away. For that, it's more of a reserve type thing, but I would think that you'd want to certainly turn it on immediately and look at that. And then also you're gonna have to follow up. If you have customers that purchase from you every month, they're gonna now start seeing tax on there. So you have to be prepared to be able to have the conversation with your customer to say, why is their invoice different this year from that? And basically, you can just say, well, we screwed up. No, you want to say, we as a business continually look at our mapping of taxability, determine this, and for the best, yada, 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 we're now putting tax on this invoice.
Yeah, all really good points. Start with gross sales by state. If you can sort that, that's where you just want to start. So at whatever your 2 o'clock Central Standard Time, when you're done with this, you go sort gross sales by state by year. Just do it in a calendar year. If you're over the threshold in that state, then you've got an issue and contact your tax provider. Do not go register and start collecting in the state. It's just start filing. It's a really good way to get audited. And it's really a red flag to the states if you just all of a sudden start filing in that state without understanding the compliance requirements that you may have had. We're going to go into next time what to do should you find or it is determined by someone else that you have exposure in that state. There are ways of mitigating those things without just jumping right in, remitting a whole bunch of tax that you thought you owed or start collecting it and then get audited. That will happen.
All right, thank you. The next one here, does Vertex have a place to see what the nexus requirements are per state?
I'm not 100% sure if it spells out each of those requirements. I'd hate to answer yes. I know that there are in some of the tools, whether it's someplace that's public to see that or whether that's just limited to actual customers. I don't think it would be something that's public out there, but we can certainly follow up with the answer to that question.
Sure, I can give you some tips on this one. There's a third party out there, Carol, if you're on here, it would be It's nice to see you again. The Sales Tax Institute does a great job of putting these type of things out there and maintaining them. You don't see this out there a lot because the maintenance, right? Somebody can just print it off and it expires tomorrow, right?
That's right.
And that's why I like to say is the advice is as good as tomorrow because it's probably going to change.
It's a good point. Yep.
It's a little bit of humor there, but that's a good place to go and you can get the economic thresholds there. Otherwise, I mean, I've got them. I'd be happy to, send them to you. But again, there's always the caveat is they may change and they will change by the example that we just showed you next year. That's a fact.
Yep.
Great, thank you. The next one, what about income tax? Has economic nexus changed income tax standards?
Yes. Yeah, it has. It's evolving. We kind of went into it. There's a lot to it. It's still very much in the gray, but yes, it has changed. The filing requirements have changed, and there are different types of kind of income, right? Franchise being one of those, or just business tax. So it's based on income, but it's not actually the income tax. It's in addition to. So there is the chance that you don't owe sales tax, you don't owe income tax, but you do owe business franchise tax. State of Texas would be one of those instances. It's rare that you ever even know it till you get the notice that, hey, we believe you're doing business in our state. And if you're wondering how do they know you're doing business, it's because one of your clients got audited. I mean, there are lists just being compiled all over the place, and that's half of the auditor's job is to understand and gather information based on your clients, your vendors, and any other purchasing or selling habits that you have in those states. And they just contact you.
Yeah, and that's a good point, Chris. Just across the board, when you get audited, they didn't just pick your name from a hat. They found you because of something else. So if you get a taxing jurisdiction that reaches out to do an audit, before you sit down and do with them, you should be researching and saying, okay, if they're calling me from X state, what do I do in that state? And I would evaluate how you assess tax on the products and services for that jurisdiction before you even talk with them. Because if they got your name, there's something you're doing incorrectly. And you want to look at that again and reevaluate to identify what that exposure is. So when you take it up the chain and say, hey, I got a letter from the state of this is what we do, this is how we tax it, I still agree or I disagree, and here's the exposure. You want to have all that before you engage them.
Yeah, states are definitively sharing as well now too. They've become very friendly. So the compilation of these lists are being shared. So if California shares their business activity list with the state of New York, New York runs it against their list, and anybody that they don't have, they send a questionnaire. Believe it or not, a very aggressive state is the state of Maine. I wouldn't have guessed, but the state of Maine is an aggressive state, and really just reaching out to any business that they can find and asking them, are you doing business in our state? We've identified the state of Florida as actually what we believe to be cold calling businesses, just asking them. And it's the nicest person in the world from the state of Florida. And if you answer that wrong, you can expect to be audited. And then they are no longer necessarily your friend. They're nice. So all of these things really need to be taken into consideration. If you don't do anything from this particular webinar, take away from never answer a questionnaire on your own without having somebody review it. The questions are designed for you to fail the test. So you have to know how you are answering those. Otherwise, you are going to get audited.
And one thing I'll add to that is if you're the person, you're that management level person that has to answer that questionnaire and you need someone to review it, don't go up, go down. Go to the person that's doing it every day because they're going to understand what's on there. People look at it like, oh, I got to share with my boss. No, if you're the boss, share it below because they know the answer better.
That's good advice.
Yep. Any other questions?
Yeah, we do have a couple others here. Quick, any thoughts on taking different NFT transactions in sales and use tax impact? So far, Puerto Rico, for example, is in the process of implementing their digital goods definition to include NFTs. Do you think if something similar passes, will the US states follow?
Yeah. I do.
Yeah, I don't want to go into a lot of detail, but yes, I'm sure they're all going to be looking at that. I mean, each jurisdiction, we know this across the board. When one jurisdiction influence stuff, even as Chris just shared a few seconds ago, states are sharing. If you start putting something in, someone else can look at. So just a simple answer is yes.
Great, thanks. The next one here, does a specialty retailer with a physical presence in a state need to apply the sales tax rate based on the branch location or the delivery location of the equipment? The specific example, the retailer uses its own vehicles to deliver the equipment.
So I think that for me, that gets into asking a specific, is it taxable or not taxable? And I don't want to answer that question by telling them what the law says on whether that's taxed or not. I think that question is going to be very specific on the jurisdictions that they're discussing. So I don't want to go in there and say, yes, it's taxable. No, it's not. I think they need to determine where these services are being performed and do some research to find out its taxability based on that situation.
Yep, very true. I would say that it's most often destination based, but that's not to say that it's a guarantee, because there can be destination based versus origination based sales. And generally it's whichever one's higher. So in the state of, I believe it's Arizona, right off the top of my head, is an origination based sales state, meaning if you generate the sale in Phoenix, you owe the Phoenix sales tax no matter where you've delivered it to.
Right.
Most states, though, are destination based, is where that where the tax is applied. There's also some other considerations to that say if you've taken it from one state, Minnesota, which is taxable, into Iowa where it's not taxable, Minnesota will try and tell you that you owe Minnesota sales tax because you didn't pay the Iowa sales tax.
Yeah.
We can generally get you out of that one, but it's definitely a game that gets played, and it's all about how you're handling it in your record keeping.
Yep.
So Larry's exactly right. Specifically, you want to drill into that. Generally speaking, it's destination based, but that doesn't even always apply.
Right.
So it's a perfect sales tax question,
Yeah.
maybe with 100 caveats.
Right. Do we have maybe one quick one we can get in, or?
Yeah, we do have just one other question here. We have remote workers / salesperson in different states that we issue laptops and printers to, but pay use tax on where we initially receive the items, and then we ship it to the salesperson in different states. Is that correct, or should we be using?
So generally, so generally you should be taxing on where it resides. So you should be basically, taking a change on your use tax and reducing the amount of tax you paid on the side where it was purchased and paying the sales tax or use tax where you're going to actually keep that computer. So you want to make sure that yes, because when that auditor comes in and says, do you have a presence in the state? And you say, yes, I have 3 salespeople. You want to be able to show that we've paid sales tax for the equipment in there. Also, to follow on that question, please be sure that you follow any personal property tax when you have that salesperson in there to show the physical asset residing in that location. Your company may have that computer listed in the corporate office in one state, but it's actually being used in the other. You want to make sure that the asset is classified on where it's being used and personal property tax return filed and paid, if applicable, where that computer is being used.
At the local jurisdictional rate.
That's correct.
Great, thank you. Doesn't look like we have any other questions here live, but we will be sending out a short survey here following the webinar. If you have additional questions, please feel free to put them in that survey so we can capture that and get that over to the team. With that, I'll hand things over. Do you guys have anything you'd like to add in closing?
Nope, just the next one of these is what to do and how to mitigate any type of compliance exposure that you found based on what we talked about today.
Yep.
Awesome, great. That next session again is March 24th at 1 o'clock. Please go to the Bergen KDV website to register for that. Otherwise, we'll see you all later. Thanks for attending today.
Thank you.
You.